Okay, welcome back. This is the third and final lesson of week 1. The dictionary defines a budget as an estimate, often itemized, of expected income and expenses. Some people don't like the term budget though, because it seems pretty restrictive. This is why the term spending plan is used instead. I'll use the terms interchangeably, because essentially they mean the same thing. Most expenses you incur are attributed to your lifestyle. This is everything and anything you spend on a day-to-day basis and everything that comprises the way you live. However, one expense that I will separate from the others is a savings expense. This is the expense of tomorrow. This expense, or series of expenses, is what will drive your goals forward. One major distinction, though, a savings expense is that it rarely is known to have remorse like a lifestyle expense you may have. In other words, saver's remorse is a lot less common than buyer's remorse. In fact, I've never seen anybody that had saver's remorse, meaning they had an extra $10,000 sitting in a checking account or savings account, compared to people bought the latest phone or item like that and really weren't happy with it 2 days later. There's an old adage that you cannot get something from nothing. This holds true in the financial world as well. A commonly used example that's joked about is that you cannot win the lottery unless you buy a ticket. Although I do not advocate playing the lottery or gambling in general, it's an example I think most people can understand. It may seem obvious that you must accumulate a nest egg before your money can grow an egg, but this is commonly overlooked. Another benefit of systematically saving is that it takes the pressure off of the rate of return you need to grow your nest egg and accomplish your goals. We'll talk about this later. Some people need assistance in increasing their savings. Some don't. This section is for those of you who want creative ideas to improve your savings. There are other various behavior activities you can do to increase your savings, but this is just a short list. The first thing many people do is to isolate their savings and make the money they've saved harder to access. This may be done by opening up a FDIC-insured online savings account that could be linked to your checking account. The idea here is that the money is out of sight and therefore out of mind. Well, that is until you absolutely need to dip into it. Your temptation to dip into your savings is lessened or reduced by the fact that you're not constantly reminded of its existence. If you were to make deposits into this account automatically on a periodic basis, it could build up without you even noticing. Consider doing something every paycheck, every month, or even every week. If you get a raise, this should include a portion of your increase into your savings account. Many employers offer a 401k retirement plan where you can elect to contribute either a percentage of your income or a specified flat dollar amount. Electing a percentage is preferable as every raise automatically increases the dollar amount being contributed into your retirement account. Another example of what you could do is set milestones with rewards. What do I mean? This is for people that don't like to save. They can give themselves a reward when they reach certain milestones as a way to look forward to achieving something. For example, you might want to set a goal something like if you don't have anything in your 401k, for instance, you might want to set a goal that when you have, let's say, $10,000 in your 401k account, you can buy yourself that one item that you've been waiting for. Now, of course, it defeats the purpose of doing all this if you end up draining your savings account or borrowing against your 401k in order to buy that one item. But if you set a realistic goal, set a milestones along the way, and then reward yourself, this could make something that you look forward to. One classic way to increase your savings goal is to write down everything you spend in a 3 or maybe 6 month period. This tactic may help you resist meaningless expenses since you may not want to write them down. You have to justify them to yourself. This method also helps you see where your money is going. For instance, a daily Starbucks trip for coffee may cost you only $4 each time you go, but if you were to add that up over 6 months, those trips could add up to $600 in a 6-month period. In a year, this could be $1,200, if not more. For larger items, such as the latest electronics, phones, jewelry, fashion items, things like this, consider maybe waiting 30 days after you first see or hear about it. You might realize you don't need those things at all. This behavior alone may save you thousands of dollars on an annual basis. In the next week, you'll learn about taxes further. However, it's important to note there are various tax-deferred savings vehicles that are available to almost everyone. Your homework would be to see if your employer offers one of the plans listed here. These plans allow you to save money for retirement while reducing your taxable income. They let you also systematically save on a regular basis. If you're contributing a percentage instead of a fixed flat dollar amount, you will automatically increase your savings each and every time you get a raise. Some of these plans offer a match or an incentive from your employer to utilize them. Because you save money in taxes by using these, you may be able to save for less. What does this mean? This means if you save $100 from every paycheck, meaning you contribute the $100 to your retirement plan, this may only result in a $75 reduction in your paycheck because you're actually saving $15 to $25 in taxes just for making that contribution. If you don't have a retirement plan at work, it's not that big of a deal. You may still be you may be able to open a retirement account called an individual retirement account, also called an IRA or IRA. IRAs offer the same tax deferral benefits. If you have a retirement plan at work, however, you will want to talk to your tax advisor or your CPA to see if you can use both your company's plan and an individual plan while getting tax deductions for using both. Both employer-based and individual retirement accounts offer tax deductions for contributions as well as the contributions growing tax deferred. This means you will not have to pay taxes until you withdraw those funds. And this lets your investment grow without your having to pay taxes on the interest, dividends, basically any kind of growth. Once you take a withdrawal, however, the funds are being distributed and they're taxed as a result at regular tax rates in the year that you make those withdrawals. For every gimme, there's a gotcha in life. So although you're getting a tax deduction and you're getting tax deferred growth, if you withdraw the money before age 59 and a half, you may be subject to a 10% penalty in addition to paying taxes on the distribution. It's important to note the gotcha here is that this is for long-term savings. These accounts are not to be used for short-term savings like a checking account or savings account.